Good afternoon and welcome to the LexisNexis Masterclass. We are going to be waiting a minute or two just to make sure we have the full audience, a large number of participants joining at the moment. So we'll give it a minute before I start the introductions. Okay, excellent. So welcome to This Is My Masterclass. What we're going to be talking today about is decrypting crypto. And are you prepared to advise on the digital economy? My name is Greg Dickerson. I'm the Managing Director for LexisNexis in the Pacific, and I will be shortly introducing our panelists. But first, let me acknowledge the country I stand in. And as part of that acknowledgement, it is good to acknowledge and introduce myself as well in my ancestral context. So I'm a South African of Dutch, French, Huguenot, and British descent who emigrated here to this beautiful land in 2000. And today I stand in Gamaragal land in Daru country. And I'd like to show my respect to traditional custodians of the land, of elders past, present, and emerging, on which this meeting takes place. And because it is virtual, of course, to acknowledge the traditional owners of the lands in which you stand. So a very, very exciting topic today. And great panelists. First up, we've got Nick Bishop, who is the co-founder of Bishop & Fang, and he's got over 25 years of experience in financial services. His roles have included head of Australian fixed income with Aberdeen Standard Investments, managing director at Gresham Partners, and recently Nick co-founded the capital advisory boutique Bishop & Fang. He's worked on capital raises for enterprise blockchains and DeFi projects, and we will de-jargonize a bit as we go, but as well as working on NFT platforms. And Bishop & Fang is a partner of the Web3 consulting collective, Not Centralized. Nick, it's great to have you on the panel. Second panelist is Susanna Wilkinson, who's the digital law lead for Australia and Asia at Herbert Smith Freehills. She's a senior lawyer with Herbert Smith Freehills, specializing in cutting-edge legal issues arising from the adoption of emerging technology, digital assets, automation, and infrastructure. A lot of changes happening in our economy are related to those. And she has over 17 years experience with leading firms in Australia, the United Kingdom, and Russia. She's also the global head of the digital law group, driving digital transformation of law, including the development of smart legal contracts in conjunction with Herbert Smith Freehills multidisciplinary teams. And is the chair of the Digital Commerce Committee of the Business Law section of the Law Council of Australia, and co-founder and director of the Digital Law Association. Susanna, it's great to have you here as well.
Thanks, Greg.
And the final panelist is Alison Cripps, who's also going to help me moderate the session. And she's a practical guidance legal writer for LexisNexis on cybersecurity, data protection, and privacy. She's over 15 years of experience at leading international and national firms, including Allens, Henry Davis York, and Maddox, as well as in-house at the ASX. And after a diverse career, has developed a passion for cybersecurity, data protection, and privacy law. She has a particular interest in cybersecurity strategy, as well as the organizational management of privacy and data security breaches. Alison, also great to have you on the panel.
Thank you.
And I'm the managing director here at LexisNexis. I'm running the Pacific business, that's Australia and New Zealand. And my background is I was the chief technology officer at CoreLogic prior to coming here. So let me just set the scene a little bit for today. We're going to be discussing crypto assets and the associated technologies, solutions, and the legal ramifications. And from what was a relatively simple but profound invention with Bitcoin about 10 or so years ago, the blockchain has changed and the crypto landscape has morphed into a very, very complicated environment with multiple different solutions and technologies, enabling different ways for people to interact, build businesses, sell different items. And so for me, blockchain crypto, the key is really, and the excitement that I get when I think about it, is the potential role in which it reimagines trusted intermediaries in our economy and how in which interactions can happen between parties that are two-way atomic, so you can pay and receive goods at the same time. But I think it's important as we go through the discussion, as we work with the panelists and we ask questions, both from us and the audience, is to make sure that we sort of de-jargonize this. And this is what this conversation is going to be. We're going to try and lift it up. We're not going to go too much into technology, and we're going to try and remove as much jargon as possible so everybody here can get a real feel for what crypto is, the implications for us, and also a feeling for what the future may bring. To start though, let's go in with a polling question. So I might ask Tam if she can throw up the polling question. The polling question is, do you think crypto is doomed to be a tech craze that markets will eventually outgrow? So single choice. First option, it's here to stay. It's an opportunity for business growth. It's doomed to failure and will only ever be for tech enthusiasts. It's just a craze, but I don't feel confident enough in that conclusion to ignore that it's here. Crypto, it's a waste of time. And depending on the timing, if you'd done this a couple of months ago, we might have had a completely different answer, but let's see what our attendees say. And just while we're waiting for you to come up and make the answer, please ask as many questions as you like through this. There's a Q&A button at the bottom. If you click on that and ask a question, I will pick that up and that will then be able to flow through to the panelists. So please feel free to ask questions, and as many questions as possible would be great to keep the conversation flowing. Okay, let's have a look at the results. Tam, can you put up the results? Wow, okay. So it's here to stay. It's an opportunity for business growth. So that's 58%, followed by it's just a craze, but I don't feel confident enough in that. So I might throw over to Alison and the panelists to make comment on that.
Yeah, maybe. Look, I think, oh, sorry.
No, go for it, Nick, go for it. Go for it.
Yeah, no, I'm just going to say, I think it's interesting that very, very, very few people really in the extremely dismissive camp. Now, that's not a huge surprise given they've bothered dialing into this to this masterclass, so that at least is encouraging. But broadly a divide between look, I'm just not sure, it's too early to say, and then other folks saying look, it's certainly here and a business opportunity. And I think in general, this role of that we can play of separating maybe some of the hype from some of the underlying technology that is genuinely transformative. I think that's hopefully what we'll try and cover off on today.
Absolutely.
Susanna?
Yeah, look, I think I'm just getting a message here saying my internet might not be stable, so please let me know if I start speaking like a robot. I think we have seen some pretty tumultuous last couple of weeks in the crypto markets, but I think it's really important to, as we go through this session, to unpack what is the underlying technology and what are the use cases, and which ones of those use cases will inevitably be a hype and a fad and will pass. But what will we be left with, once those experiments have kind of fizzled out, or people have had positive or negative experiences from them, and where do we see value in the way that society uses this technology going forward? So I think there are real opportunities, but I think the lawyer in me will say we must be careful as we go on that journey, because we will inevitably make mistakes.
Yeah, completely agree. And I think there's a whole element there, as you're saying, there's almost a froth that all needs to get blown off before that underlying value comes up, which is similar to the early days of the internet and other technologies.
And I think the last few months, Greg, we could all be forgiven for assuming that crypto was going somewhere. Since November 21, the market capitalization of crypto has fallen in value by 2 trillion. And we've seen the crash of Luna stablecoins taking 26 billion off the market, Celsius assets frozen in response to declining market values, and of course, the first crypto law case in the Facebook metadata case. So I think we could be all forgiven for assuming that blockchain is going to fail, but the reality probably is that the technology that underpins the crypto landscape, that is the distributed ledger technology, or as we know it as blockchain, is one of the most successful and exciting technological advancements of this generation. And even if the assets themselves succeed or fail, the technology that underpins them, the blockchain, it's not going anywhere. It's akin to suggesting the internet will disappear. The internet, and indeed blockchain, is always going to be here. So that's why we're all here, because with this new technology comes a new marketplace. It needs regulating, and we as lawyers can't afford to be complacent. we have to jump into the crypto boat, so to speak. Certainly that's our view in practical guidance, which is why we've recently launched a whole new and expanded topic in practical guidance, cybersecurity, data protection and privacy, covering all things crypto. I really encourage you to have a look at the new content after the masterclass. There's a lot there to have a look at, and it's great content.
Yeah, excellent. I agree, Alison, completely.
Can I also just jump in there, Alison, just picking up on that point you mentioned around the drop in value, and we have seen some really significant drops in value, but I think it's also useful to rewind maybe 6-12 months before and look at the incredible rise in value that creates that volatility to allow the drop. You know, if you zoom out on some of those charts, you can see some incredible movements, which evidences a broader adoption or a broader interest by markets around the world, and that also comes with some risk. But
yeah, I think that's a valid point. If you go back 2 or 3 years, it's still gone up quite a bit. Yeah.
Absolutely.
We should probably do a poll at the end as to who of the panelists actually hold crypto and if we've kept it through it.
Yeah, we can talk about that now. That's fine.
Susanna, can we start with you? Can you give us a brief overview of what blockchain is before we launch into the bigger issues around lawyers working in this space?
Sure, Alison. Yeah, happy to. I think the key points to take away, if you haven't really come across blockchain or distributed ledger technology, understanding that it is technology. Ultimately, it is a form of database that does some very clever things through very clever maths and some cryptography. But there's 3 key features that really underpin a lot of what we're talking about today in the creation of digital assets. So the first thing is that blockchain allows us to store in digital form, to store value in digital form. Now that might seem a little bit counterintuitive. If you've been using internet banking for years, you would think that there's value in electronic digital form, but actually we've used the internet and electronic devices for communication up until now. So we don't need to unpack, don't need to go into how it works today, but ultimately it allows us to store value in digital form. And one way that it does that is through recording all the transactions that are relevant to a particular blockchain or an asset on a very public ledger. This is an analog example, but if you imagine a whiteboard in a communal kitchen in the office and everybody writes every transaction on the whiteboard in permanent marker, it's there for everyone to see, and it creates a collective memory. And so this is what is part of what helps us to create this store of digital value. And that record of transactions and that collective memory allows for this trust by design sort of ecosystem. You'll hear the term trustless, but I would actually I think of it as trust by design, and that it has inherent features that allow peer-to-peer transaction. And Greg touched on that before, the idea that we don't need to use an intermediary if we're using these systems properly. So those 3 key features are the ones to bear in mind and take away, that they allow us to create these digital assets that may or may not have value, and it's incredibly versatile. We can use it for a whole range of use cases, in the same way that a database can store information about almost anything. Is the database inherently good or bad? Well, it depends on what you're storing. It depends on what you're recording. So thinking about it through that lens, I think, will help lawyers as we go through and look at, well, how should the law be responding, and what are we actually trying to respond to? I'll stop there because we could talk for another hour on what it is, but hopefully that gives the key features.
I might highlight the one point you talked about, because it sort of does change the whole what a transaction is, and the fact that the transaction is so open, visible, it happens seamlessly. And a lot of the world is hinged around the law of transactions, the law governing how we transact. So that's for me is one of the major reasons why blockchains are so exciting. Even if the blockchain itself goes away, I think that thinking is never going to go away.
And we talk about this transparency, and it's also really important to understand that, sure, if you're a digital native and you've been coding most of your life and you know how to use a block explorer and you're into understanding the code, and well, then it is very it is very transparent and very accessible. But for a vast majority or a vast section of the population who are not comfortable with interrogating a block explorer, it is still fairly distanced. And I think we will need to see that sort of the user interface simplify if we're going to really receive or harness the true benefits of this underlying technology in the way that the purists would say that this technology presents. I'd say that's still not quite accessible to the vast majority of the mainstream users.
Yeah. Before we switch back to Alison, I know you got another question, but we've got one come through from the audience. Maybe I'll throw this to you, Nick, which is, can you give an example of a transaction that would happen on the blockchain?
Yeah, I mean, look, a myriad examples. I mean, the simplest one is simply the transfer of one Bitcoin to another. And why do I say that simple? It's because, you know, Bitcoin really was the first, global use case for a completely permissionless, and as Susanna said, trust by design, which is also known as trustless, ironically, in crypto world, blockchain. So I could simply, through a wallet address, I could simply decide that, Greg, I'm going to send you a Bitcoin, and I hop into my, I could use a whole number of interfaces to do this, but whichever particular interface that I'm using to do that, I can simply transfer a Bitcoin from my wallet to your wallet, and that will appear in minutes, usually. I mean, that's one of the downsides of Bitcoin being a hyper secure, but being a hyper secure sort of old blockchain, is that it takes a little bit longer than some of the more modern blockchains, but it's hyper secure, completely anonymous, and completely borderless, and I can transfer value in that fashion. That's a simple example, but you can think of anything from, transferring real world assets, property rights, bank guarantees, obviously artwork, as we know now,
NFTs,
the ownership of artwork, anything that you can attach to an NFT, and then a whole variety of cryptocurrency, fungible cryptocurrency tokens themselves. So yeah.
And I think that leads on nicely to our next question. Nick, can you give us an overview of the assets that we see traded on the blockchain?
Yeah, I mean, new examples every day added, because it is a real primordial soup. Is a Cambrian explosion of activity in the crypto space, particularly in terms of now real world assets that are being migrated to being both DeFi and TradFi native. So yes, of course, a whole variety of cryptocurrencies. And while we mentioned cryptocurrency, I would just stress that the naming of cryptocurrencies is somewhat unfortunate, because they are not designed, in the vast majority of cases, they are not designed to be a replacement for fiat. They're not designed to be transactional currencies and assets. And so I think the media and some of the overtly crypto hostile folk will jump on them and say, oh, but I'm never going to pay for my coffee in Bitcoin. The transaction speed is a fraction of that you get through Visa and so on. Yeah, exactly right. And I don't think anyone who's involved in this space in any kind of serious fashion would ever propose that. So fiat and crypto will be side by side. Think the easiest way, I think, to think about a lot of these tokens is like a almost like a ticket to a fairground. So we have examples of that from way back, where you get a paper ticket to pay for all the fairground rides. Once you're in that fairground, you cannot use fiat currency. You will get your long stream of paper tickets, just the same when you go to the little the bowling places and all those places where you'll earn tokens from the machine, and then you go and exchange the tokens for a prize at the front. You can't buy those tokens with fiat currency. It's just the digital version of that. So if I want to go to a really exciting country called Ethereum, and I want to go and experience some of the things that happen there, some of the games, some of the DeFi apps, some of the artwork there, some of the metaverses there, I need to get the native currency of this exciting country called Ethereum before I go there. In the same way that if I go to Japan and I try and go and spend Aussie dollars in Japan, good luck with that. I need to get some yen to access all of the exciting things that I can do in Japan. It's just the same way. Think of it as a ticket to access an ecosystem, and the value of that ticket to access that ecosystem will fluctuate. And obviously, the more things happening in that ecosystem, the more things you can do, the more valuable the ticket is to enter that ecosystem. So that's maybe an analogy to use.
Yeah, I think that's a really helpful analogy, Nick. And I might just add to that, another way to think about it is that the tokenization, we use the term pretty loosely, but The ticket's a brilliant example. You know, we're used to tokens in the physical world. We've been using them for a very long time. The packet of data that is in the token or the smart contract, we'll come on to that in a bit, but that, you know, there's standardization has allowed us to tokenize almost anything. And if you think about it in two different ways, this digital ticket can point to something that is itself natively digital, or can point to something that is in the real world. So it is just a means of representing something. And again, super versatile. So whatever you choose to represent will then impact what you can and can't do with it, and what you should and shouldn't do with it, and whether it should or shouldn't be regulated. So it is just a way of representing something, this tokenization. And we use digital rails then to transact in respect of or deal with that digital representation.
And I think the important part is as well, when you transfer that token, so when you walk into that fairground and you take that token, you pay somebody for the ride, that transfer is a transaction. You get the ride, they get the token, and that is on the blockchain. So it's very clear, even though it's digital, it's almost exactly the same analogy as in the real world. They have ownership.
It's like the record in your bank account of transactions. You can see exactly what's happened. Yeah.
Just before we carry on, there was a question here: where does the block database live? Who maintains the computer it lives on? We don't want to go too much into the tech. I'll answer that for a second. Essentially, it's shared amongst a whole network, and they all have the same copy, and they all agree on that copy, and that's what proof of work or proof of stake is. They all agree on the copy. So that means nobody can play with the data, because everybody else in the network will know that that's happened. They'll know that this fraud happened, and that's why it's so trustable. Cool.
Yeah, and really, you know, what DLT, which is not exactly the same as blockchain, but for lots of intents and purposes, they're interchangeable ideas. But D, decentralized, L, ledger, T, technology. So it's a ledger, it's a record. I mean, we've had ledgers really since double entry bookkeeping, and can thank the Italians, I think, way back in the day, or probably the Romans for that. So it is distributed in the sense that, as you said, Greg, it lives on multiple nodes at the same time. So if I drop my, you know, laptop in the harbor today, it's not like, oh my goodness, the Bitcoin ledger's just disappeared because Nick dropped his laptop off the ferry. So there is no single point of failure in these networks. They're distributed. It's like a mesh of information.
Yeah, it's like the collective memory is the way I like to think of it. It's yeah,
it's a nice analogy. Yeah,
it's a very nice analogy. Yeah, we talked for a long time, and Susanna put it down, and it's good.
This is why you need strong female presence in all of these forums.
Speaking of brief, Susanna, can you give us a brief overview of how smart contracts fit in?
Okay, smart contract is effectively a computer protocol. In very simple terms, it's a little bit or a long bit of code that is designed to run, and it lives on a blockchain. So it has all the benefits that we've just talked about. And the idea is that it's a pre-programmed set of code that will do something. In the context of digital assets, where this becomes really interesting is when we have a standardized version of this smart contract that allows interoperability. So the tokenization, the reason why we saw this explosion of tokens is because there was a standard set of criteria. So if you imagine a bit of a checklist of what you want your token to do, so who owns it, where did it come from, what's the value, what's it supposed to do, what's it pointing to, you get this sort of list of criteria. Everybody uses the same version. It's a little bit like a standard letter template in Microsoft Word. You know, if everybody fills it out the same way, then we all know what a letter looks like. We all know what to expect and how it will work. And this smart contract code can then facilitate the transactions on the blockchain. So it's the automation behind it that gives the certainty of what should happen. I want to transfer a token. I know that if I treat it properly, it will go and do these things. So smart contract code, think of it like a set and forget kind of program that does what it says on the tin. Smart contracts we'll come on to the way that technology is incredibly powerful, but for the lawyers in the room, you'll be thinking, well, it's not a contract. And then a lot of academics have said, well, it's neither a contract nor is it necessarily smart. It's just doing what it was pre-programmed to do. So the best way to think of a smart contract is a packet of data of code that will run and you'll get a fairly predictable outcome based on the inputs.
And probably a good example at this point is something like parametric insurance for like a flight cancellation. I think that's used often as an example.
Yes,
Yeah.
yes, that's exactly right. So if you know you've got very certain inputs that come into that smart contract algorithm, and it says, so if the plane is delayed by X number of hours, we pre-agree that you will be entitled to X dollars of insurance claim. So it's a very standard if this, then that, and you can use it in a very specific, limited use case.
Yeah. Of course, they do get a lot more complicated, and we'll get onto DAOs and all the rest of it later.
Yes. Yes.
Greg, we might move on now to have a discussion about what some of the main issues for lawyers are operating in this space.
Yeah, so maybe the first question, and Nick, you pointed out an article today on crypto versus foreign currency fiat. I think that came out today, right? Jim Chalmers made a ruling. So maybe the first question probably is cryptocurrency going to be regulated the same way as fiat?
Well, maybe, I mean, Susanna, definitely the expert here in this sense, but in the same way, no, but the same principles, I think, need to apply. Otherwise, we have dual standards. So, the same principles of certain actions that should be, sanctionable and prohibited will apply. But just because the technology is slightly different to fiat, I think there will need to be nuances here. So, for example, we have no consensus globally yet of what exactly is a cryptocurrency. Is it a commodity? Is it a security? And there is no it either, because there are multiple examples. We have about 18,000 different cryptocurrencies. So, and they do different things, right? So we don't even have a consensus over how they should be treated. So regulation is very nascent. I think because there are a lot of headline grabbing examples of harm and loss, then I think sometimes there is a sort of an overtly hostile regulatory focus on what is still a very nascent technology. But the same principles will apply, but the means in which that regulation is delivered will need to be fit for purpose. And what we have in cryptocurrency is an extremely fast moving, particularly this idea of atomic settlements, which you touched on, Greg. You can't regulate transactions with atomic settlement and finality in the same way you can a transaction that might be, say, T+3 settlement. You need a different way of regulating that. So same spirit, different implementation is how I would characterize it.
Yeah, and I think your point that tokens are not always the same and they're used for different purposes is also really interesting. So then I might throw that to you, because how are tokens currently regulated and application of existing laws?
Yeah, excellent question. So again, stepping back, we have this broad concept of digital assets, which is anything that can be represented in digital form. We can break that down into subsets. So a cryptocurrency is often what we call the native token of a particular blockchain platform. And that's what we often call a cryptocurrency, because it's the example that Nick gave earlier. If you go to that ecosystem, you need that token. And we then have a broader kind of category of crypto assets, which use some of the similar technology, but could do a whole lot of different things. And what's really important from a legal perspective is that what these digital assets or crypto assets can actually change over time, because remember we said that they're effectively linked to a smart contract, so they can collect data over time and they can be used for different things. So it's really important from a legal perspective that we look at what are the principles that we should apply in deciding whether or not aspects of this ecosystem and the activities that fall within this ecosystem need to be regulated. There are a lot of crypto assets and a lot of cryptocurrencies that effectively have the same purpose or activity as securities and financial products. We have laws that regulate securities and financial products, but those laws were written decades ago before we understood this technology. So there's a disconnect in whether or not whether all of the laws are fit for purpose. And there, exactly as Nick said, there are some nuances there with the extreme examples of this technology where some of the harms are different or they're not present because of the nature of the technology. But I would say that they're actually in the minority of cases. If you have something that is presenting the same potential harms, the same potential risks as a security, then in my opinion, it should be regulated as a security. But our laws don't make it easy at the moment. They don't make it clear. So what we need to do is find the right way of bringing these entry ramps or creating an on-ramp for these particular assets and digital assets to be regulated according to the appropriate legal framework. And we do need some new laws, or we certainly need some clarity in the existing laws of how that works. I think where it gets really complicated is Australia's laws at the moment are complex when it comes to financial products and market licenses and AFSLs and all of these sorts of things. So if there are any financial service regulatory lawyers on this session, you'll know that it's a rich tapestry of things that need to be considered. And what we need to avoid is creating parallel regimes and duplicate licensing regimes that create additional complexity. We've got some pretty significant law reform projects underway in respect of the entire financial services. The Law Reform Commission's doing that exercise at the moment. So we do need to make sure that we're not duplicating and cutting across. We need to look through the technology to what is the harm that's being created. We need to look at our laws holistically. Do we already have laws that protect consumers in certain circumstances? We have consumer protection laws around misleading and deceptive conduct. Those laws still apply to protect against those harms, irrespective of the technology that's being used to create the harm. So we do need to have this harm-based lens that we look through. We need to make sure that our laws are harmonized and not duplicating existing regimes. And we also need to look at how we can promote innovation in our jurisdiction in a way that is internationally sort of harmonized as well, because up until now, Australia has been, there's been a perception that crypto is unregulated, in the sense that it wasn't necessarily clear how it was regulated. But I think those days are over, and what we've seen in this incredible volatility in the last couple of weeks, and a lot of people being making investments into cryptocurrencies or crypto products where they and they have lost money. I think the important part is that the technology claims all of these benefits of being decentralized, of being peer-to-peer, and in its it does have those benefits. But if you interpose intermediaries into those decentralized systems, so the exchanges or custodians or people who purport to hold your assets on your behalf, that often undermines the benefits that the technology was espousing. So that becomes really complicated. And it's probably too much detail for this session, but this issue of decentralization and centralization, if you're putting a centralized exchange in the middle between customers and the decentralized products, you know, that is undermining the benefits of decentralization. So we need to understand where the line is in terms of what we're proposing to regulate and not regulate as well.
Yeah, completely, Susanna. You brought up a lot of great topics there. Probably, no, it's awesome. It's awesome. I probably might just sort of pivot slightly, because I think you highlighted two things, sort of the on-ramp and off-ramp onto, because generally a blockchain or a crypto world is not localized. It's not a particular country. It's global. But a lot of the regulation comes to those crypto exchanges, which is your on-ramp. You know, and that's generally registered here. And the question with that comes in, are we in Australia, one, our regulation harmonized with the rest of the world? But the other question is this a competition? Is there like a level where as a country we can get more benefit by being better regulated, or you know, does it actually help us as a country? And I'll probably throw that to Nick as well after I've asked you.
Yeah. Look, better is a value. There's a value laden.
No, there's a value. Sorry. Yep.
Assessment there between this better regulation. But
what I mean by that, does it unlock innovation for us? Is it a growth opportunity for Australia?
Well, so if we get it right, so we need clarity. We need to not stifle innovation. We don't want to scare people away because we're overly heavy-handed, and that would happen if we had a disproportionate regulatory response. So if we came in and tried to over-regulate and create this huge compliance cost and burden, that would definitely scare companies away. So we need to strike a right balance. And yes, if we get it right, there is an incredible opportunity for Australia to take a leading role here, because we have a very appealing jurisdiction. We have strong rule of law, we've got good governance, good policies and procedures, we've got a great strong economy and all of the right things that can attract investment if we can get it right.
Yeah, and look, maybe I would just add to that, there is, to an extent, there is a bit of a global turf war to attract some of these the biggest ecosystems and some of these really big spending venture capital firms who have poured a lot of money into sort of Web3 and crypto over the last 3 to 4 years. Now that doesn't mean that the loosest equals the best. It absolutely doesn't, because that, as a business trying to plan your strategy and trying to plan what you do, you need to have the clarity that Susanna talked about in terms of, the rails, the regulatory rails that you're running on. So it's not so much, oh gosh, we need to be as loose as possible to attract all of these, but definitely not. I think pragmatic, clear rules that are interoperable with global standards leave Australia in a great place to be able to attract some big projects. I mean, bear in mind, we've got some amazingly valuable businesses here that work in Web3. Immutable is the third most valuable Australian private company ever, and it's the fastest Australian unicorn ever. And Immutable is a Web3 native technology business that is a great Aussie success story. We don't want to be sending those sorts of value-adding businesses overseas. That would be a great shame. And I would point out one thing. Obviously, we spoke a reasonable amount about harm here, and so I would hate people to leave this call thinking, "Oh my goodness, the guy spoke a lot about harm. It is all this really damaging space." The beauty of this space is that the data is pretty readily available and is very easily interrogatable. So, great firm called Chainalysis does a regular annual survey on the amount of illicit wallet activity in this space, and illicit is defined in a number of different ways. Every year, that number is less than 1%. And in the last couple of years, that number's been less than 0.5% of all wallet activity is illicit. Now, if you acknowledge that about 5% of US dollars in circulation are used solely for money laundering, and this is, again, stats that you can get, these are official stats. We can see that actually the level of illicit activity is just nowhere near as prevalent as you would. The bog standard good news stories do not make it into the media. If it bleeds, it reads, and so the scams and the blowups will make it to the media. But the reports of me doing some bog standard stuff, sending some interesting tokens between me and my daughters, for example. My wife doesn't have a wallet yet, but me and my daughters, that's not getting reported. Of course it isn't. It's not particularly exciting, but it's a tiny minority of illicit activity.
Yeah, which goes to Lucy's question in the chat. How does confidentiality work in a decentralized database? The reality is it's far more open. When I've got cash and I can go and illicitly use the cash, as you said, 5%, but this is trackable. So if you pay a ransom in Bitcoin, they can see where that's gone to. It may eventually get paid out in a currency which the country lets it happen, but you can trace it all the way through to the point where it leaves.
Yeah, and really, to talk to her question, another great example. Keith Grossman, who's the president of Time magazine, in the wake of the Ukraine crisis, launched a campaign to raise funds for Ukrainian nationals and Ukrainian refugees. Raised, I think it was over $40 million in a few hours in Bitcoin. That was really quite seamless. He stood up a multi-sig wallet, bang, Bitcoin goes into that wallet, you raise those funds. The hardest bit in that whole process for Time to get those funds deployed was going into the fiat banking system and getting fiat currency into Ukraine through the European and Ukrainian banking system. It wasn't raising the capital in Bitcoin. That was done in a few hours.
Yes. So a few questions from the audience. One, which is just sort of refining coins and tokens. I see the use of the words coins and tokens used interchangeably, but I understand that there are differences, which I'm not sure what they are, e.g. ICOs versus token issuance. That could be a long conversation, but maybe Nick, go for it for a minute or two, and then maybe to Susanna as well.
Yeah, sure. I mean, Susanna touched on this as well. So really, we've got to think about the native sort of access token for an ecosystem, which we'll generally say is a cryptocurrency. So the native currency of the Ethereum blockchain is ETH, well, Ether, we could all call it ETH. And you need ETH to go into any ecosystem that is building on the Ethereum blockchain. Now, the kind of tokens you build with that and create could be totally different from Ethereum, but you have to start there at the sort of the base layer. It's a little bit like, if I'm buying equities in US dollars, I can buy a whole heap of different equities with my US dollars, but I've got to get my US dollars first. Otherwise, I can't buy anything. So it's the same analogy in essence. And the way that I like, I mean, stats will tell you that crypto is about 8 times more volatile than small cap equities, something along those lines. It is an inherently volatile asset class. That's why I think this use of the term currency is a bit of a misnomer, because people think of currency as having, you know, a stable face value, all that sort of stuff. So yeah, I maybe point that out, that difference. So we've got.
Yes. Sorry, and I would add on top of your analogy. So you say in order to buy stocks on the share market in the US, you've got to first buy dollars, which is the equivalent of buying Ethereum before you can get an Ethereum type token. But also, if you think about it, if I want to buy a house in the US, that's non-fungible. One house is not the same as another house. I've also got to get US dollars, but then I can buy an NFT.
Good analogy. Token. Yeah, very good analogy.
Whereas a stock is fungible. One share is another share. Yeah.
Yeah, and I would also just add that, again, we're going back to understanding that the tokenization can be of anything. So we have these natively digital cryptocurrencies for particular blockchains, but then we also have, you know, the digital assets or the crypto assets, the non-fungible tokens and so on, which could point to anything. And it also, we've got this peer-to-peer feature, remember. So on the stock exchange, you buy and sell shares, and you trading through your fiat currency. So I buy share X and then I sell it for fiat and I buy a different share. But some of these protocols and platforms allow us to trade. It would be like a share for a particular company being able to exchange shares one for one without going through fiat in the middle. So there's an incredible versatility in the way that these tokens can be used, because they can inherently store value. So that probably gets a little bit more complicated into the DeFi space, but this idea that we don't always need to go back to fiat to exchange tokens one for one.
Yeah, and maybe something to add there, because hopefully people's brains are ticking over now, but when you think about the layers and the steps that you can remove by doing that, this is why inherently there's an interest in DeFi protocols to make traditional markets more efficient. So to sort of expand on both of your analogies there, imagine if I had some Telstra shares and I didn't want Telstra shares, I wanted instead Deutsche Telekom shares. Now, Deutsche Telekom shares denominated in euros, traded on Eurex, Telstra shares denominated in Aussie dollars, traded on the ASX. Imagine if I could just go into a protocol, I didn't have to sell my Telstra, take Aussie dollars in my custody account, go to an FX provider, swap my Aussie dollars for euros, open a euro capable share trading account, take my euros, then buy my Deutsche Telekom shares. Imagine all the intermediaries who are clipping a ticket on the way through there. And we know that the SWIFT banking system is certainly not atomic. So that's going to take you a few days to move that money, right? So if you could instead cut out all of that and then just go straight from Telstra, Deutsche Telekom, bang, that pair is tradable live, 24/7 liquidity, remember, in crypto, 24/7 liquidity. There's no T+3, T+5 settlement. That's really what we're talking about here. The speed unlock, the collateral unlock, the value unlock is in that kind of interoperability, which Susanna spoke to.
Yeah, well, that's a much better way of explaining it, Nick. Thank you.
Susanna, I'm just going to jump in here in the interest of time. Yeah. Can I divert you for a minute to talk about smart legal contracts? Because I know it's an area you have particular interest in, and I'm sure it's going to be of interest to a lot of our audience. What are smart legal contracts and how do they differ from smart contracts?
Okay, so we've talked about this incredible functionality that comes with automation. You know, this, if we're using digital rails and we've got these benefits of speed and efficiency, how do we take that technology, those benefits, and use them in the performance of contractual terms? So this is what we're talking about when we're talking about smart legal contracts. Computer code in and of itself is imperfect from a traditional legal sense. It is not always going to satisfy all of the elements of a legally binding and enforceable agreement. So if we have at one end of the spectrum pure computer code that can sort of be triggered to carry out a pre-agreed function, let's go to the opposite end of the spectrum, which is a traditional paper contract. How do we take that contract and embed the functionality of code while it's all wrapped up as a legally enforceable agreement? And I think that's the most useful way of thinking about smart legal contracts. It's the digital transformation of the law and legal instruments. So you take a valid and enforceable contract, You have it in digital form. You can choose which of the provisions are valuable from an automation perspective. And that automation can be almost anything that lends itself to automation. It could be a payment. It could be a transfer of funds. It could be the calculation of a CPI increase. It could be a rent review mechanism. It could be as simple as an internal notification. It could be an email saying your contract is about to expire, or there's been an overdue payment. The contracts are incredibly versatile and incredibly robust. So we should be careful not to take a really narrow view of what the capabilities of smart legal contracts are, but it's important to think about it from a law first perspective, which is how do we bring the benefits of this smart contract technology, the distributed ledger technology, to the extent that creates value and benefits. And we can talk about that in a little bit more in detail, Alison, if you'd like to. But in summary, a smart legal contract is a legally enforceable agreement in digital form that has the benefits of digital connectivity and automation. And that can come in any number of ways that are valuable to the counterparties.
And Susanna, I think you said in our pre when we caught up before the session, like a smart legal contract can also be it's shared in a way, whereas before, I'd have my copy and you'd have your copy, and we'd go off and we'd have our contracts. But that fact that you've got a shared live contract that is executing, it's a pretty exciting concept, even if it's not on a blockchain.
Yeah. So and this is where it becomes really interesting. The UK, the Law Commission in the UK, England and Wales have done some scoping studies and looking into the validity at law of smart contracts, and there's some fantastic materials that they've produced if anyone's interested. But where we need to really get into the nuts and bolts of what makes or when would code be legally enforceable as contractual terms, and there's a whole bunch of legal issues around that. And similarly, when can we get a legal contract in digital representation or in a digital expression to be valid from a legal perspective and to perform the contractual obligations in a way that's enforceable? And this is the interesting part that you mentioned, Greg, which is that instance of the contract is effectively, think of it like software. If you and I share that version of the software, it has to be shared because we need read-write functionality to that software for it to be updating itself. If we respectively have our own copies and we can manipulate those copies, then we've lost the single representation of the evidence of our agreement. And that's the really key part. And this is why I would put to everybody that a smart legal contract needs to be running on secure digital infrastructure that has that capability of holding a shared instance of the contract.
Yeah. Which is why answering one of the questions coming through, which isn't DocuSign, for instance, a smart legal contract. The answer is no, because that's, again, it's digitally signed, but it goes off. It's
not in any way.
Yeah.
Watch this space, because what DocuSign are doing is, with an eye to the future, DocuSign have very cleverly pulled a lot of people onto a digital platform that in time will, I'm sure, look to have functionality that allows contracts that are in a shared digital form to do other things. And this is what we're talking about. We're talking about the relevance of contracts. And contracts, as a lawyer, spend a lot of time drafting contracts. They are vitally important to the economy. They underpin so much of the activity that we have, but at the moment they are disconnected from the digital worlds and the digital processes that they seek to govern. So bringing those contracts in a dynamic sense into the digital economy is going to be incredibly powerful.
Yep.
There's an interesting question I saw flash up before, which referenced coding equity principles. I don't know if anyone can see that.
No,
but
I think we can. I think you have to read it out.
Okay. I'd have to do a bit of a search because it's not. I don't think they've done them in. Oh, maybe they have done them in time order. Sorry, I beg you.
They have. There's one here on cryptocurrency and accessibility. Sorry.
Yeah, and actually, there's an interesting question from Susanna on PEXA. So I can quickly answer that.
So the
yes
question
is
let's ask the question to the audience: is the PEXA platform for electronic conveyancing a form of smart contract? Go for it, Nick.
It's not a form of smart contract. It is a form of digitized real asset, though. So And that's it. It's like a segue into the world of, it's still a centralized system, to be clear, but it is a digitized e-conveyancing is the digitization of a manual conveyancing process. Now, if you wanted to look at a, sorry, go, Susanna.
No, I was just going to say it's a great example of this digital transformation of legal systems and processes. So we've had the Torrens title system, which is a central record of title. And what that did was really important because it did away with the need to have the physical paper deeds. So deeds used to be an incredibly valuable asset. If you held the deed, you owned the land, basically. And so the Torrens title register was a really important development. So making that register digital and allowing faster and more efficient transactions in respect of that. So traditional conveyancing settlements were very slow and cumbersome when in an analog sense. So it's really helpful to have that digital transformation. And I think this is where lawyers need to start thinking about this technology differently. Many other industries and sectors have undergone digital transformation. Banking sector, 10, 15 years ago is a classic example. The law is on the brink of this same digital transformation. We are using AI systems in doc review, e-discovery. We're starting to use technology to change the form and functionality of legal instruments. Legislation being written in code is going to be incredibly powerful for digital systems to interact directly with the source of law. Now, lawyers play a vital role in intermediating between the laws and our clients. But thinking about this through the lens of digital transformation of law is very helpful for lawyers, because you start to see, well, where are the points in the process that are inefficient, slow, cumbersome, or perhaps lacking in relevance to their purpose. And I'll stop because I could go on about this for hours, but this is the point here. Why are we bothering to do this? Because it will be valuable. And so why do lawyers need to pay attention? Because anything that is slow and inefficient will inevitably be changed, whether we change it or it is changed for us. Does that mean that all lawyers will be out of a job? Absolutely not. Does it mean that lawyers need to start thinking about how we do things more efficiently? Absolutely, yes. And technology will play a part in that.
And as part of that, there's a great comment in the chat saying, how would you code principles of equity for contract? And I think there's a point.
Well, okay. So here we go. Not everything will lend itself to articulation in code, but even just having it accessible in a way that can be interacted. So we could have a smart legal contract that's speaking to parliamentary sources to know when updates to legislation happen. So we can understand that there'll be a change to a particular legislation and we can be contacted and notified about that pretty quickly. So in the same way that not every part of a legal contract can be expressed purely in algorithmic logic, it doesn't need to be, because the technology will solve for that. We will have a way of storing a contract or legislation, and the relevant parts will be articulated in computer code, which will allow for that functionality and interoperability. So we don't have to think in absolute terms of all natural language or all code. We will be able to find very powerful and useful hybrids.
And and one great example of everything we've been talking about is a client of ours, and I noticed that I happen to have their T-shirt on, which is a business called Ligon. Purely coincidental, but Ligon digitizes financial contracts, and they've started with bank guarantees. Now, here's an awesome example of the applicability of the technology. Bank guarantees, previously a bearer instrument, a tripartite agreement. There's an applicant, an issuer, and a beneficiary. They all have a copy of the bank guarantee. It is a bearer instrument. Plenty of instances of those being photocopied. CBA letterhead, Westpac letterhead, whatever. Bank guarantee is photocopied. Fraudulent bank guarantee, you'd have no way of knowing. They're also stored, because they're stored physically. One great example of a Ligon client, a large landlord, had 10,000 bank guarantees in a safe in Parramatta. Parramatta floods fairly often. The safe was in the basement. Guess what? The safe wasn't waterproof. 10,000 guarantees spoiled, gone, evaporated. Millions of dollars worth of effectively collateral disappears. Classic example of, now, do they have to be digitized with blockchain? No. But what Ligon has done with their network, they've made it that there is no single point of failure and weakness in the network. Each applicant and beneficiary has a node on their network, and each issuer. And so you don't have any single point of reliance and single point of failure. You get these instantly executable tripartite agreements in now a standardized legal language that completely replaces a bank guarantee.
Yeah, and that's a perfect example of where you look at the process. Where is a pain point, a point of failure, a point of weakness? Where is inefficiency? And we see this across the board as lawyers doing our job in the traditional sense. You know, where could we be doing things differently? And that's a really great example. And I think it's also it's a good example as well to say that, you know, blockchain and distributed ledger technology is often said to be a problem looking for a solution, or a solution looking for a problem. But the idea that, you know, it won't solve for everything, but it does create incredible opportunities that we don't even have half of them on our radar yet. There will be so many applications that we haven't got to. And smart legal contracts in and of themselves, once they are up and running on this kind of digital platform, could be a digital asset. And that digital asset will have value and will be tradable in ways that traditional contracts are not. And there's all sorts of benefits that flow from having those contracts in a truly digital form.
Yeah, and that's really the mind shift, I think, which is so huge in this space. We've only got 4 minutes, and I don't know, Alison, you had a lot of other questions you're going to ask, but I'm given we probably want to close it up a bit. I'm just going to throw one, which is an interesting one, which goes almost back to accessibility. So the question here is, how accessible is cryptocurrency, and especially to people of lower socioeconomic communities? So can it only ever be a digital benefit to create generation of wealth for sort of the higher echelon, you know, people who already have access to wealth? And I think there's been a lot of promise of cryptocurrencies sort of. Sorry, you go for it, Nick.
Yeah, no. I was going to say quite the opposite in my mind. I mean, I think, you know, we can. Bear in mind this is still experimental, which is interesting. But anybody with a mobile phone, and if we think about, say, sub-Saharan Africa, right? Mobile phone adoption absolutely huge. Completely didn't even stop at fixed line. Fixed line adoption terrible in sub-Saharan Africa. Mobile phone adoption extremely widespread. You know, you think about the increasing rollout of platforms like Starlink, courtesy of Mr. Musk, and we have universal mobile phone access pretty much everywhere. The barrier to adoption is exceptionally low because as soon as I have a mobile phone, then I can have a digital wallet. I have no need to open a bank account. If you choose to do that in a non-KYC'd way as well, all you really need is a mobile phone number. Hey presto, you have a cryptocurrency account. Now, what's your on-ramp into that cryptocurrency then? There may be, not necessarily, a requirement to have some fiat currency to then acquire some cryptocurrency, but not necessarily. There are plenty of platforms out there where you can learn to earn, you can drive to earn, you can play to earn, you can watch ads to earn. Basic attention token from the Brave browser is essentially an engage to earn platform. Philippines is an amazing example. Axie Infinity has lifted hundreds of thousands of people above the poverty line in the Philippines because they're able to play to earn in the online game Axie Infinity and earn tokens when they couldn't even access the labor market. But now they make a living full-time playing Axie Infinity. Now, I'm not saying that's the answer to the world's problems, but the idea of democratization and empowerment is actually.
But even things like Dogecoin, the original thing with Dogecoin, you could just drop a couple of Doge and it was a way to tip people on the internet, right? Which is very powerful. Suzanne, I might give you 1 minute before I close up. Sorry about that.
No, that's fine. I was going to just add that also very low transaction costs relative to traditional markets, and also because of the fungible nature of cryptocurrencies, you don't have to buy one Bitcoin. You can buy 0.000000001 Bitcoin. So it is relatively affordable. You don't need to be buying fixed units in a unit trust or, you know, a whole number of shares. So there is incredible flexibility. And I think the other thing to recognize is that the success of this technology and all of the use cases around the technology are all depending on ease of use. So the super easy user interface, which is all on your mobile phone. So the biggest barrier is actually leaning in and learning about it and finding trusted advice or trusted information, because there will be a lot of people out there trying to make a quick buck. And this is not financial advice, but if the returns seem far too good to be true, maybe there's some whiskey on it and you should probably dig a little bit deeper. because yes, money doesn't just actually grow on trees, but in this case, it's virtual value. So it's a perception of value. I'll stop
Absolutely. There. Thank you. And thank you, Susanna. Thank you, Nick. Thank you, Alison. I know we've got 30 or so questions, tons of questions going through, which we'll post up and put answers on our blog. So everybody's got that. We're also launching a blog tomorrow on on NFTs, which we didn't even get to, non-fungible tokens. We sort of touched them. So please look out for that blog that's coming tomorrow. And we will definitely be posting this. The final question was a fun question. How is everyone doing in this crypto market? I won't ask Nick and Susanna. I'll say that I'm substantially down, but I'm quite long on crypto. For me, it's a multi-year thing, and I'm sticking to the core protocols that I believe will have long-term value. Thank you all. Thank you, Susanna. Thank you, Nick. Thank you, Alison.
Thank you,
Greg. Thanks for hosting.
Yeah, thanks for organising. Thank you.
Thanks, everybody.